The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Matt Miller. We are kicking off to the closing bell here in the U.S. Going to check on where markets stand after a little bit of a rally that we've seen. The S&P 500 up 1.33% right now. And this is fascinating because it leads us to gains of almost 5.5% for the week. It's been so up and down that you may not have noticed, but we are up on the week. The 10-year yield also, unfortunately, up on the week. Big gain here, 6.5 basis points today to 448.76. But especially if you look at the 10-year yield versus bunds, it's been a 50 basis point spread, and that's the most we've seen in decades. NYMEX crude oil right now up $1.47, but 61.54 at a very low level. Not the 55 that we saw at the depths, but still cheap for oil, and gold going the other direction. An all-new record high on the gold spot right now, $3,235 a troy ounce is a level that we've never seen before, Scarlett.
Yeah, the price action has been all over the place, but this week really made clear that Sell America was a big theme across markets. The dollar slid to a 6-month low. Treasuries at one point were set for their worst week since 2019, and stocks initially struggled to find their footing even after President Trump hit pause on most of his tariffs. But reassurance this afternoon from a top Fed official that the central bank is ready to help stabilize markets and hopes that the White House will move on to its growth agenda, short up the price action. But great damage has been done, at least to consumer confidence, which is crumbling. Inflation expectations spiked to the highest since 1981 as Americans worry that tariffs will lead to higher prices. Several Fed officials insist it's for that reason they're unlikely to cut interest rates even as the economy slows down.
Those tariffs, if implemented, if fully implemented, pose upside risks to inflation. We don't know if those upside risks will be short-lived or maybe longer-lived. We don't know if we're talking in terms of months or quarters and years.
And now it's corporate America's turn to give their take on what they see in the economy. Banks kicked off their first quarter earnings season by using variations of the words uncertainty, unknowns, and turbulence to describe their lack of visibility. JP Morgan CEO Jamie Dimon says that he expects a lot of companies to pull their financial guidance, which, of course, will make it all the tougher, Matt, for investors to determine valuations of companies.
Yeah, I'm glad, though, that you brought up the University of Michigan survey. I have a great chart from that survey as well showing the gulf of sentiment in the U.S. We've never really seen it so wide. So you can find this on WSL Politics, which offers you a wealth of information if you have access to the Bloomberg terminal. So WSL Politics shows you everything from tariffs to betting odds to University of Michigan data. This blue line is complaints. These are negative comments that were not solicited, and you can see that we have never seen it this high in the entire survey. The white line is positive comments, also relatively high compared to what we've seen over the last couple of decades. But it's the spread between the two that you can see here in red that is really so surprising. It just shows you how, well, maybe not surprising, just shows you how bifurcated American opinion is on what's going on right now. Scarlett?
All right, some big divides there. So let's turn now to the banks and kick things off on the big show with Mike Santomassimo. He is the CFO over at Wells Fargo, and he joins us now from their trading floor. Mike, it's always good to speak with you. A pleasure to have you on your earnings day. The big question here is not so much about what happened in the first quarter, but the path moving forward. And I want to start there with what you're hearing from your customers, whether they are individuals or companies.
Yeah, thanks, Matt and Scarlett, for having me again. You know, look, I think first you got to, that as we come into this environment, the consumer is in good shape. Consumer continues to spend. Most of our commercial customers are in good shape as well. We're not seeing any kind of big deterioration across the portfolio. So we come in with a pretty good, strong foundation. And as you sort of now look forward, what's happened is you've got some uncertainty, right? And what uncertainty does is cause people to take a step back and say, how's it going to impact me? How's it going to impact the demand I might have for my products? Or how's it going to impact the cost of my goods sold? And they're going to take a pause and see how that may change their perspective looking forward. And that's pretty natural, I think, for folks. And that's what we're hearing overwhelming for clients is they're taking a step back. on the commercial side saying, okay, I got to really understand this a little bit better. But again, on the consumer side, what we're seeing is just good, consistent performance. Like, people are still spending, people are still out there, using their debit and credit cards, and so still, quite robust in terms of the overall activity. But I think, most commercial customers are taking a step back and trying to evaluate the situation.
Understood. So, Mike, you left your full year guidance unchanged. What would it take to actually update that and provide more details to investors?
Well, I think, the good news is we left it kind of, the guidance unchanged, as you said. And, as you look at, what's happening right now, there's a whole bunch of factors that go into where it's going to go for the rest of the year. First is just overall deposit levels and mix. That's stabilized and looking pretty good overall. We've seen some deposit growth in our consumer business. We saw the stabilization, in terms of people looking for higher rates continue. So all positives as we sort of look forward. We saw a little bit of loan growth in the first quarter. Unclear sort of how that progresses throughout the year. We are expecting to see a little bit more as we go. That'll be a factor of sort of how people feel about the certainty of where things are going. And then I think it's just the macro view on rates. And I think you can see over the last just couple days or week or two, the expectations for rates, both long-term and sort of short-term rates, have been changing, quite a bit. And so we need to see that stabilize. And I think that'll all be then those are all the key inputs into kind of what net interest income will look like for the rest of the year. But as of now, from where we sit today, we still think the range we gave in January still is reasonable.
You're not likely to see a lot of things stabilize in this administration, Mike, and I wonder how you hedge against that. Charlie Scharf earlier, or in the statement, I think, said that he applauds the administration's willingness to look at barriers to fair trade, but there are certain risks associated with such significant actions. And how do you hedge against those potential outcomes as broad as they are?
Well, I think you have to look back, and I think we tried to cover a little bit of this on the call, and look at the full universe of stuff happening. There's a lot of good things happening on the regulatory side, both for banks and more broadly, and we're hopeful that some of those changes will get implemented, and that'll be helpful for banks like us to sort of help support, the broader economy, the markets, our clients, and so we're hopeful that'll continue and unabated from sort of what's happening, with trade policy. And then I think it's a matter of just getting a little bit more certainty in terms of what the guardrails are and the timeline is on the trade policy. It doesn't have to all be locked and loaded and done. It just needs to have a little bit of guardrails around it. And then I think people will very quickly sort of adapt from there. And you have to continue to kind of look beyond sort of what you read, in the headlines every day, and just see what, fact first, versus what may be presented to you. And so, I'll go back to where I started. Like, the good news is, the economy is still pretty active and pretty strong. And most customers come, into this environment in a pretty good place. So that's all sort of supportive for, things continuing to be, pretty constructive for the rest of the year. But the risks have definitely gone up. There's no doubt about it over the last couple of weeks. And so we have to try to find ways to, continue to support clients and then make sure that we're thinking about all those risks appropriately.
I think, going back to your earnings this morning, Mike, a lot of people on the street were surprised by lower loan loss provisions than they expected. Saul Martinez from HSBC notes that as well as the positive tax expense helped out. Gerard Cassidy at RBC also said that your performance relative to their estimate was driven by a lower than expected effective tax rate and lower than expected provision for credit losses. Why keep that so low when you're staring so much uncertainty in the face here?
Well, it is. We talked about this on our call a little bit. You first start with just the performance of the portfolio, which has done very well. We had a couple of years ago now, 2 or 3 years ago at this point, had done a bunch of credit tightening actions on the consumer side, and that's serving us well as we come into this environment. And so you can see the performance continue to get, better and better across many of those portfolios. And then when you look at the commercial side, again, same thing. It's been performing quite well. And I think as you look at the assumptions that go into the allowance, we're already assuming that unemployment ticks up quite a bit. And we noted on the call that we did increase the allowance a bit more, as it relates to some of the uncertainty that we've seen as we came into the end of the quarter. So if we hadn't done that, we would have seen a bigger release there, given how well the portfolio is performing and slightly lower balances across some of the portfolio.
Mike, can you give us an update on the asset cap that's now 7 years old at Wells? It limits your balance sheet to the size it was at the end of 2017. I know that the bank has made a lot of progress this year, resolving 5 consent orders in the first quarter alone. Is there anything more to resolve on Wells Fargo's end?
Well, I think in the release and in sort of the call comments that we had, you can see as you pointed out that we've made a ton of progress, not only closing the consent orders, but we also noted that we completed much of the work that's common across the orders that got closed and some of the other orders, and so we're just going to keep continuing focusing our energy on the things we can control, which is making sure that the work's done at the highest quality, and we'll let the Fed ultimately determine sort of the timing of the asset cap, but we feel good about the progress we've made, and that's thanks to the thousands of people across the company that have done that.
So if the Fed removes the cap sometime this year, what are the initiatives? What are the things that Wells is going to start working on right away to look for new streams of revenue growth?
Well, most of the strategies that we have in place are going to be the same ones. So we've been investing in our wealth management business, our credit card business, our corporate investment bank, our commercial bank. None of that changes. What happens, in a time when we have more flexibility on the size of the balance sheet is we'll be able to deploy more balance sheet to our markets business, in terms of financing trades that we can sort of help our clients with, and then maybe more broadly in certain types of deposits that we can take. But a lot of the core strategies don't change. We're going to continue to execute those, and those will drive growth in the balance sheet and the revenue in the company over a long period of time. But we'll have a little bit more flexibility to do some more activity in our markets business.
Mike, I saw that net interest income was down due to the impact of lower rates, but partially offset by lower deposit pricing and higher deposit balances. And I wanted to ask about that specifically. A lot of families, when they're facing uncertainty, will make sure that the rainy day fund is stocked up. Are you seeing that?
No, a lot of what we've seen now is just consistent sort of activity and growth over the last, 4 quarters, and what you're seeing in the first quarter is just the cumulative impact of that. We're not seeing big shifts in behavior at this point, across either the consumer or the corporate client base. And so maybe that'll happen in the future, but we're not seeing that at this point. It's just normal activity, plus some growth that we've seen as we've been able to grow a little bit more in all the businesses on the consumer side. But we're happy to see some of that growth come across the client base.
Mike, great to get so much intel from you. Really appreciate you sticking with us here on The Close. Mike Santomassimo there, the CFO, Chief Financial Officer over at Wells Fargo. Let's turn back to the markets now with the S&P higher year to date. You can see now 5.7%. So this is the highest we've seen, this highest weekly gain that we've seen year to date since, I believe, November of 2023. But if we climb a couple of basis points higher, it'll be November of 2022. So really strong gains. And I think you have to consider the fact that we started the week below 5,000. After the big drops we saw on Thursday and Friday, we were at 4,900 and change to open trade on Monday. Here with more context is Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments. Victoria, I guess a lot of people who have been in the market throughout are not going to feel better that we had a good week since last week was so brutal. What are your clients telling you?
Yeah, it's interesting. I actually spent the last week talking to clients, and much to my surprise, many of them were okay with where they're positioned in their portfolios. I think a lot of that is because, as you well know, at Crossmark, we've been a little bit more defensive over the last 6, 9, 12 months. We had moved more into some defensive positioning. We'd increased our staples allocation, reduced some of our growth allocation. And so our clients feel like they're somewhat positioned for the volatility that they're seeing. Doesn't mean they're not concerned about what's going to happen going forward. Are inflation expectations going to continue to go higher? Are we going to see growth continue to decline? What's going to happen with trade policy, with monetary policy? There's lots of questions out there, but there's not the level of concern where people want to come completely out of the market or where overnight lending rates are showing stress. So I think for now, people are just kind of watching and waiting, maybe being a little more defensive in their positioning. And we think that's probably the best place for them to be.
Right. And as you mentioned, that shift in positioning happened already prior to this week's declines and then advance. When it comes to what you're anticipating, price action wise, have we seen the bottom for now? I know this is a loaded question, but buy the dippers have come in on a day like today. What reassurance do they have that this will hold?
Yeah, it's, I wish we had a crystal ball, Scarlett, where we could figure this out exactly. But there are some things that can kind of, historically give us an idea of what we may be seeing. So when we've had spikes before in the policy uncertainty index, like we did over the past week and a half, then you tend to have a stronger market 6, 9, 12 months out, which puts us, later towards the end of this year. But at the same time, when we have had large pullbacks, large corrections like we saw Thursday and Friday of last week, beginning of this week, it is very typical, 85% of the time, 1 to 4 months out, you come back and you retest those lows. That puts us maybe, at the latest end of August, end of the summer, as we still have some volatility in this market. So I don't think we're out of the woods yet. Have we reached the actual tradable low? I don't know, but I think we will go back and probably retest where we were, because I think the volatility and the uncertainty is going to continue to hover over this market, at least for the next few months.
Victoria, it's been incredible to watch the treasuries market. I mean, I was talking about the spread between treasuries and bunds earlier, 50 basis points of movement that we haven't seen, in decades like that. Given that Scott Bessent and this administration seem to place so much importance on lower rates, do you buy treasuries here at 4.5 or the 30-year at 5?
Well, I don't know what everyone else is doing, but I can tell you, Matt, before I came on air, I was buying some treasuries for some of our clients. And I think what people need to do is kind of look at some of the shorter end of the yield curve, lock in some near-term income that they can have, but look further out the curve. I don't think we're going to get back up to 5% this year, barring any huge unforeseen circumstance. We had 4.80 on the 10-year earlier this year, and I think that'll probably be an area that will mark the highs for the year. So I would put in a little bit of longer term exposure to fixed income. And then as yields start to come down, which I think they probably will as we go through the rest of this year, not only do you get that nice cash flow component coming out, but you will get some price return as well. So I think it is a buying opportunity, not just on maybe some of those growth names that got hit pretty significantly on the equity side, but for the fixed income side as well.
Right, but I don't think anyone's saying that the volatility in fixed income and treasuries is going to end anytime soon. And what a lot of market observers have noted is that the market is functioning okay. The bond market's functioning okay, but liquidity is not great because volatility is high. How can you tell? How do you determine when the sell-off in treasuries turns disorderly?
Well, a lot of that has to do with the overnight liquidity markets, those funding rates that we see and what those overnight markets are doing. There's not stress in those overnight funding markets right now. It's actually doing pretty well. When you look at treasury swaps, those are being very orderly at that point in time too. So those are the areas that we would want to watch to see if there is stress beginning in the markets. It's what has been a canary in the coal mine previously. And we're just not seeing that yet. And we're also not seeing it, Scarlett, in investment grade credit. High yield credit spreads have widened out significantly, and we would expect that in this type of environment. But investment grade has held pretty well. So again, I think you've got some elements in the fixed income market saying underlying, I think your liquidity is okay. But yes, lots of volatility. The MOVE index is telling us that that's the way it has been and probably will be for the foreseeable future.
All right, Victoria, thank you so much for joining us. Victoria Fernandez is Chief Market Strategist at Crossmark Global Investments. Coming up on the close, we're going to take a deeper dive into the other bank earnings out this morning and what to expect from those due out next week. Erika Najarian, Managing Director and Equity Research Analyst of Large Cap Banks, will be joining us next. This is The Close on Bloomberg. It's time now for our top calls, a look at some of the big movers on the back of analyst recommendations. And first up is gold miner Newmont, notching a shiny new upgrade to buy over at UBS. The analyst says with gold equities now rallying, the macro backdrop for gold is increasingly more supportive. UBS raising its price forecast for bullion to $3,500 in 2026 and expects more cash returns. Price target also goes up to $60 from $50. The share's up 8.5%. Next in line, Mizuho initiating coverage of Walmart with an outperform and a $105 price target. The firm says Walmart is a must-own name in consumer with shares that show promise even in a weakening economy. They say the stock provides investors multiple ways to win thanks to Walmart's strong advertising, membership, and marketplace businesses. The share's up 2% right now. And finally, Verizon dialing an upgrade to outperform over at Evercore. The firm says that although the stock is lagging behind peers AT&T and T-Mobile, it's because Verizon isn't getting the credit it deserves for several tailwinds, including resilient wireless subscriber growth, as well as robust fiber optic efforts. They're calling Verizon a top wireless pick and top value idea at that. Shares up just over 2%. And those are some of our top calls. All right, let's turn now to the banks with several reports out this morning and more coming in the next week. And bring in Erika Najarian, Managing Director and Equity Research Analyst of Large Cap Banks and Consumer Finance over at UBS. Erika, I want to start with JP Morgan Chase, the biggest U.S. bank out there. And their equity markets print was phenomenal, really a testament to how the volatility in markets is boosting trading revenue overall. Does this set a high water mark for the rest of the industry that may be hard for them to match?
I think so. I think both JP Morgan and Morgan Stanley could have set the bar quite high for the reporters next week, which would be Goldman, B of A, and Citigroup. At the end of the day, the equity market volatility should be good for everybody. In other words, sell side desks tend to be long volatility, so that volatility is good. And so far in April, both Jamie and Ted Pick over at Morgan Stanley had said, this volatility has continued and we've traded it well. But that's the key phrase, Scarlett. We've traded it well. And we'll see how well Goldman Sachs, Bank of America, and Citi have traded this equity market.
How is that juxtaposed by advising fees? M&A, I know it's not dead, but definitely isn't as alive as we thought it was going to be this year. And we're seeing IPOs that really have just been absolutely frozen. So is that trading gain that we would expect in this much volatility just totally outweighed by a drop in advisory fees?
Not necessarily. It depends on the bank, right? A bank like JP Morgan earns tremendously more in trading. But actually, there's one bright spot still in investment banking, and that's debt capital markets, or DCM. But Matt, to your point, given the tremendous volatility in the equity markets, advisory and equity capital markets, or ECM, you talked about IPOs, have to be on ice for some time. And, Morgan Stanley had talked about robust pipelines. And I'm not quite sure what level of certainty, these companies are looking for in order to, unfreeze the pause button on activity. As you can imagine, this administration is probably giving corporations a higher base level of uncertainty. And so it'll be interesting to see what will break that pipeline for the rest of the year.
What are you looking for in terms of expense management? That was a big theme over at Wells Fargo. Of course, it is under a Federal Reserve asset cap that limits its balance sheet growth. But this is something that the banks can control as opposed to the macroeconomic environment, which they can't. Have you heard anything from them that points you in the direction of there being a lot more cost cutting in the months ahead?
No, not at all. I think the banks are actually in really good position. Look, I think the banks, especially the bulge bracket banks, even Wells Fargo, who does have a little bit more of efficiencies that they can, use to fund some of this revenue producing growth. But most of these banks are in growth mode. And I think they're not going to give up on what could be, pretty decent next few years, just because we've had this uncertainty. So I think it's way too early for the banks to pull that lever, Scarlett.
Erika, great talking to you. Thanks so much for joining us on such an important day for you. Erika Najarian, they're Managing Director and Equity Research Analyst of Large Cap Banks and Consumer Finance at UBS. Happy birthday. day. Coming up, a broad economic discussion with Paul Romer, New York University School of Law professor. This is The Close on Bloomberg.
It's just about 3:30 p.m. in New York. This is the countdown to the close. I'm Scarlett Fu.
And I'm Matt Miller. We are looking at markets that are actually going to end the week higher, and
which is really just messes with your mind, given what we saw at the start of this week.
In some ways, it is surprising, given, I think, what we saw at the end of last week, right? It was really Thursday and Friday, and then leading into Monday morning that were so terrifying in terms of asset prices. But we had such a rally on Wednesday after the president said, this is a good time to buy stocks, that it saved us for the week. Now we're up more than 5%.
That's the case for equities, but you look at bond yields, and they are still higher from where they were a week ago, especially at the long end of the yield curve, right? The 10-year, the 30-year. We had decent auctions for both those tenors, but it doesn't really resolve a lot of questions over whether these instruments are still risk-free the way that they were maybe just a month ago or a year ago.
Yeah, absolutely. I want to bring in right now Paul Romer. He's a professor at Boston College Carroll School of Management. And, you know, there's so many questions. We said we'd get into a broad economic discussion here. But I wonder first,
could I just pick up on one point of the discussion you were just having?
Yes.
The dollar is down too.
Yes.
So it's a very mixed picture, even though, you know, the equity markets have recovered to some extent.
Well, it does seem like the dollar being down, although Scott Bessent, the Treasury Secretary, said the U.S. has a strong dollar policy. It does seem that a lower dollar is part of the goal here, if there are any stated goals. How do you look at what the president's doing in terms of tariffs?
Well, I think we're on a very dangerous path. We have committed to go essentially to war economically with China. Now, that is maybe intended to lead to a negotiated settlement, but when you commit to go to war, you have to be ready to go to war. And one of the things you want to do for your side is be clear about what the goals are. What are you trying to accomplish? And there's a lot of ambiguity right now about that.
Even the war issue, right? Because at the same time and Warren Buffett has said, you know, the tariffs can be seen as an act of war. A lot of other people have made that kind of comment. But at the same time, the Trump administration is, in a sense, doing President Xi a favor by refusing to force the sale of TikTok. It seems to be an incredibly important asset to him. And the Trump administration also isn't enforcing sanctions on Chinese companies who buy Russian oil. So it doesn't even seem like they're together in the administration.
Yeah. And I'm also worried about this recent set of firings in the administration. 6 people on the National Security Council. These are the people who help you think through, if we do this and they do that and we do this, what does that do to the odds that we end up in a shooting war over Taiwan? And, you know, the Army and the Air Force, the Navy have been trying to prepare very actively for that possibility to make sure that we can deter China and not have it happen. But the worst outcome of all here is a shooting war over Taiwan. So we got an economic war that could lead to, you know, recession, job loss, unemployment in both countries. But, you know, we've been circling around the possibility of a transition to a shooting war. So it's a very dangerous time. And like one of the things I really worry about is that the president needs to be well informed right now.
And you don't think he is?
Well, he just fired the head of the National Security Agency and the head of U.S. Cyber Command and fired the deputy too. So in addition to the National Security Council people. So, and we know that the Chinese have been extremely effective in penetrating all of our networks. So this kind of, let's just like tear up the government, it's going to leave him as a leader with no troops when this breaks out.
It feels like the administration is setting us up for a USA versus China kind of scenario, if not USA plus the rest of the world versus China. Yep. Is the rest of the world going to line up with the US in facing off against China, or is there going to be some alliances in the back there?
Well, I'll tell you who isn't, is Canada. You know, if you were trying to build some coalitions and some allies, you don't want to go insulting people and threatening them and then giving the leading candidate for the next prime ministership, give him an incentive to play extremely hard against the United States. So we've turned Canada into an enemy. And, you know, could we patch it up with Europe? Maybe, but we haven't been trying to build bridges there either. So it seems like we're pretending we're ready to go to economic war, but I don't see any signs that we're really prepared to do that. And if you're, you know, if you threaten something, you got to be able to carry it out.
I wonder, Professor, if you see any potential for positive outcomes here. When I talk to people who don't work on Wall Street, the mailman, my motorcycle dealer, my dentist, they all have this idea that we're going through a period of pain, but that the tariffs on the other side of this will lead to a global trading order that's fairer. Yeah. Can you see that as well?
I think the focus on fairness is actually misplaced, to be honest. And I think this is where leadership matters. I think we need to steer the focus slightly differently. I also think the focus on trade deficits per se is a little bit misplaced. But what we should be thinking about is income inequality and the fact that lots of people in the United States feel like they've been left behind. It is, and there's good reason to think that our policy of, you know, moving towards free trade has exacerbated that. It hasn't caused all of the increase in income inequality, but it's exacerbated it. And it's made it harder for us to do other things to stop it. So I think we should do a rethink about what strategies could we actually implement to make sure that all members of society can expect to be able to participate in growth. And that may require a rethink about trade. And I think that's what instinctively people are responding to when they say, yeah, you know, I hope something good comes out of this.
What's your take on the, I mean, as we get closer to April 15th, I think a lot more about taxes, right? And this tariff hike of 10% across the globe represents the biggest tax hike the U.S. has seen since 1982. If you take the reciprocal tariffs as they were set out, that would be the biggest tax hike since 1968. At the same time, the Republican Party continues to insist on the double taxation of a cap on state and local taxes.
Right.
Are we going to end up with more income or less?
I think we'll end up with less. That's just been the pattern recently. And there will be, I think there's a pretty good chance we're going to go into a recession just based on the uncertainty that we've had so far. If that happens, there will be pressure both for the Fed, but the Fed's got to worry about inflation. So then the government may need to do countercyclical policy by cutting taxes, increasing spending. So I think there will be pressure on the budget because of the response to the recession.
What is left of the U.S.'s standing as the global leader, the global reserve currency, the dollar? We started with that. Treasuries, are they the safe haven that they once were?
Yeah, to be honest, I don't think we know. Maybe there are people in the U.S. government who know. There are stories that are starting to show up every day now about maybe the Chinese are selling to pressure the dollar, to pressure the treasuries. You know, maybe the Chinese are planting those stories to make us worried about what's going to happen with the 1.5 trillion of, you know, securities that they own. So we don't know what's going on here. It could be that they're kind of trying to prepare themselves for this coming fight. They clearly have been strategizing about how they're going to fight this fight. But it might also just be that there is this kind of sell everything trade now that's on for a lot of people because they're just nervous about where is the United States going. And honestly, we can't tell yet how much it's one or the other.
All right, Paul Romer, really appreciate your joining us today. Paul Romer is professor at Boston College Carroll School of Management. We've got a lot more coming up on the close. China sending a chip notice that's tanking names like Texas Instruments and Intel. Those are today's stocks of the hour. That's up next. This is the close on Bloomberg. All right, despite a rally in the S&P 500, Texas Instruments and Intel are tanking as geopolitical tensions between the U.S. and China continue to escalate. They are our stocks of the hour. And joining us now for more is Ryan Vlastelica with Bloomberg News. And Ryan, this has to do with an order from the Chinese Semiconductor Agency on how they're going to retaliate against U.S. tariffs. Talk us through what's happening here.
Sure. Thanks for having me. So amid all the uncertainty surrounding tariff policy and how semiconductor stocks are going to be impacted or not, they came out and basically said that rather than focusing on the home country, they're going to be focusing on where the chips are manufactured. So this is important for Texas Instruments and Intel because they both have manufacturing plants here in the United States, along with a couple of other companies. But this does not include companies like NVIDIA or Broadcom or other names like that. Some of those are outperforming today, but TI and Intel, given their domestic manufacturing, U.S.-based manufacturing, those stocks are struggling today.
It really seems, Ryan, if I look at the SOX index, the Philadelphia Semiconductor Index, it's been on a downward trajectory since the swoon of last summer. Have we overestimated the ability of chip makers to cash in on other than NVIDIA, to cash in on the AI craze?
That's a great question. It's probably the biggest question facing the chip makers right now, because obviously in January, we saw DeepSeek come out raising all kinds of questions about what is the outlook for AI spending going to be. Other parts of the chip space, automotive chips, industrial chips, so on and so forth, those have been seeing some weaker trends. So having the AI part of the market, which has been by far the strongest growing part of the market, having that come under question is just causing a lot of sort of broad-based sector weakness. You mentioned that it hasn't hit a new high since mid-2024, whereas other parts of the market have been hitting highs regularly up until this year. So just shows you how much that has been sort of falling behind the market for a multi-month period.
Ryan, talk us through the exemptions that there are for a lot of the tariffs out there, because NVIDIA, for instance, is exempted from certain tariffs. It very much seems like you can't just make a call on the semiconductor industry as a whole.
No, I'd say that's very much the case. I'd say there's so much uncertainty right now. Things seem to change on a day-to-day basis. We saw, obviously, the pause earlier this week. We saw the new tariffs from China this morning. There's so much going on right now. It's hard to really know who is going to be impacted, how much they're going to be impacted by, how long these are going to be staying in place, if there's going to be further retaliation. There's so many question marks right now. I think evaluating valuations or growth prospects from here is extremely difficult.
Ryan, thanks so much for joining us. Ryan Vlastelica, they are talking to us about the chip makers, our stocks of the hour. Coming up, we're going to take you to the closing bell with Ann Sonders. She is Chief Investment Strategist at Charles Schwab and Company on this Friday as we end the day and the week higher. This is the close on Bloomberg.
So I don't think we're out of the woods yet. Have we reached the actual tradable low? I don't know, but I think we will go back and probably retest where we were, because I think the volatility and the uncertainty is going to continue to hover over this market at least for the next few months.
That was Victoria Fernandez of Crossmark kicking off the show. And Matt, it's quite the turnaround, at least for today. We were kind of looking for direction for most of the morning. And then in the afternoon, we took off. And you can now see the markets, at least the equity market, flying high, up 1.8% for the S&P 500.
Yeah, the bond market is doing pretty well, too. Here you're looking at the 10-year yield at 446.99. It doesn't seem that far off the highs. I think we were looking at yields north of 450 for a little while. But if you look at the 30-year, we're at 485, less than that. And we were getting damn near 5% on the 30-year, which is a point that I think everyone understands causes a lot of pain, even for the administration. So I think that turnaround has really helped us rally in stocks. Interesting to also see a brand new high on gold. I guess the dollar weakening doesn't hurt at all there, but $3,200 and change a troy ounce is the highest we've ever seen for the shiny metal.
Well, you mentioned the dollar weakening. It is still down on the day, off by 1%, off by more than 2% for the week. And
which are big numbers for the dollar.
Big numbers. And of course, we know the White House wants to see a weaker dollar, but, you know, probably for the right reasons. And I'm not sure we're getting it for the right reasons right now. All right, let's bring in our next guest for some market analysis and welcome Ann Sonders, Chief Investment Strategist over at Charles Schwab Co. And Ann, one other thing that may have sparked a bit of a turnaround in risk assets was Boston Fed President Susan Collins speaking up, telling the FT that the Fed would absolutely be prepared to stabilize markets should conditions become disorderly. How do you interpret that? Because other Fed officials have made clear they're not looking to cut rates because of the potential inflationary impact of the tariffs.
Right. And she probably was not talking about easing policy in a traditional sense, either through rate cuts or maybe even balance sheet moves, but maybe some of the more macroprudential tools that the Fed has to stem any serious dislocations within the financial markets. Thinking back to, say, a period like 2 years ago when we had the SVB collapse and what the Fed stepped in, which was exclusive of what they were doing with those traditional monetary policy levers. So all else equal, which is the ultimate caveat these days, I think that gave some calm to markets and may have also contributed to a little bit of a move down intraday in the 10-year Treasury yield, which also has a feeder into what the equity market does. I just think more broadly, a Fed that steps up even with more traditional tools of easing policy, the question is that the elixir for what ails us right here in terms of trade policy related uncertainty? And I'm not sure you can connect those dots.
Absolutely. But to that point, you know, the Fed can only do what it can do. And Collins said that the markets are continuing to function pretty well and we're not seeing liquidity concerns overall. That suggests that the price action has to get a lot more destructive, has to get a lot more volatile than what we've seen so far to warrant any kind of intervention. What would that need to look like from your end, Ann?
Oh, gosh, I wish I knew the answer to that. What we do know is there's a pain point in terms of the move up in yield and at least concerns about dislocations for the Trump administration, at least based on what we learned earlier in the week, in terms of what that pain point might be for the Fed to step in with those tools. Unfortunately, I think that's going to be, you know, they'll know it when they see it. I don't think we've hit that threshold at this point, but I wouldn't venture a guess as to whether it's some, you know, yield level on the 30-year or the 10-year or something auction related. You know, one of the rubs, too, is there's a lot of concern about foreigners selling treasuries, maybe even selling equities. The problem is the data you get on that is so lagged. The latest monthly data we have for that type of selling or buying is only through January. So unfortunately, this is the kind of stuff that we all have to glean as opposed to getting it based on hard data in terms of where any selling pressure might be happening within the Treasury market.
Yeah, there's so much to unpack there, Ann. I mean, the Treasury market is, for one thing, a lot more complex than the stock market in a lot of ways. For example, if I want to see Chinese holdings and I pull up Debt Go on the Bloomberg terminal, I might need to click the Belgium box, right? Because who knows where they're keeping them. But it does seem like the market's comforted by the idea that the Fed will step in if it gets disorderly, and that the White House is focused on the Treasury market. You know, Scott Bessent said this is Main Street's time. Wall Street's done pretty well, but the Treasury market has a big effect on Main Street. If you can borrow to buy a house, if you can borrow to buy a car. Do you think that buying Treasuries makes sense at, you know, 450 for the 10-year, 5% for the 30-year? Is that a place where you'd like to own some of those Treasuries, knowing that this administration is so focused on keeping rates low?
All right, Matt, let me give you the ultimate caveat here. Kathy Jones is our fixed income strategist, not me. So I can parrot to some degree what she and her team have been saying, which is you may want to have a little bit shorter duration here as opposed to making a bet that either, that the highs are in for Treasury yields. There's just too much of a swirl of uncertainty here, and that you want to not only maybe bring duration in a little bit, but really stay up the quality spectrum. And that's not just a call on the fixed income side of things, but that's been our call on the equity side of things. As we've talked about on this program, we've been much more factor focused within the equity market as opposed to things like sector-based investing, staying up in quality, finding that low volatility factor, that stability factor from a dividend, from a profit margin perspective. So that stay way up in quality message is what we're expressing both in the fixed income side of things and the equity side of things.
All right. So on the equity side of things, then, how much further have you had to bring down your earnings expectations from, say, the end of last year until now? And then to add to that, how much do you reduce what kind of multiple that you think stocks get at the end of this year? Do we get to 5,500? Do we get to 5,600? What's your take?
Yeah, so we don't publish earnings forecasts. We're not analysts, but I always have an assessment on the consensus and whether that seems from a macro perspective to be too high, too low, or at least what the direction of travel is. And I think we're in the 17th consecutive week where we've seen downward revisions to 2025's estimates. Now, the reason why I point out that long number of weeks is a big chunk of that was well before the experience of the last week and a half and the really, the upping pressure associated with the trade war. What we're now seeing as we head into the heart of earnings season is an increasing number of companies that are just withdrawing guidance altogether. It harkens back to the early part of the pandemic when, for obvious reasons, companies just said, we're not going to try to give precise guidance to our analysts at the cents per share level. Right now, we have seen the consensus drop to about 9.5% for calendar year 2025. That's down from between 14 and 15% at the end of the year into the beginning of this year. Mm-hmm. I think there's probably more downside to come. Analysts, when left without that precise guidance from companies, I think their bias is still going to be lower estimates as to how far that goes. And then from a valuation perspective, yes, we've seen improvement to valuations from a snapshot perspective, courtesy of the correction/bear market, depending on what index you're looking at. The problem is the motion of the denominator in the equation is still moving down. So when you have both the P and the E moving down, it makes it harder to, at a snapshot in time, use valuation as an assessment of the health of the market.
So then you go back to the qualities, the factors you say that really kind of define stocks or groups of stocks. In terms of those that might be quality stocks, I wonder how big a priority do you think it's going to be for companies to maintain or even raise their dividend in this environment to send a very strong signal to investors?
For those that are dividend-paying companies, I think either expressing comfort in the ability to maintain that dividend, may be less likely to see an increase in the dividend, other than if they decide in a sort of uncertainty-constrained environment in putting maybe some of their cash to work that might have otherwise gone into longer-term investment plans or CapEx. Yes, maybe you could, throw it into the dividend side of things. But I think that the message is also really important that we will get, or hopefully we'll get it during earnings season, even if it's not precise guidance, is how am I navigating through this right now? Mm-hmm. Given the policy uncertainty, most companies are saying, just let us know what the playing field and we can navigate around it. We still don't know really what the playing field is, but what are companies doing in the short term? Are they planning on taking the hit in their profit margin? Right. Do they feel they have the ability to pass those costs on? Are they, more consistently holding off on CapEx plans, investment plans? Are they thinking about maybe making an adjustment to their labor count? All of those broader questions, I think that's what companies are going to be peppered with in terms of questions from analysts.
All right, good stuff. Liz Ann, always a pleasure speaking with you. Liz Ann Sonders is Chief Investment Strategist at Charles Schwab and Company. And there you have the closing bell. You have a rally on the day, although rally is kind of a relative term here compared to what we saw on Wednesday. The S&P 500 gaining 1.8%, but a decided move to the upside in the afternoon. The Dow Jones Industrial Average gaining 618 points, up 1.6%. The Nasdaq doing the best of the bunch, gaining more than 2% on the day, 337 points higher. And for the week, Matt, it is up arrows all around, gains of at least 5% for the three major indexes.
I'm just looking at the bell ringers. YPF there, it says delivering the full potential of Vaca Muerta, Argentina. Is that like dead cow, Argentina? What's Vaca Muerta? Anyone speak Spanish here? No?
I don't know.
Muerta means dead. I know that part.
Yeah.
And vaca is definitely a cow. All right, in any case, we take you into the close with Bailey Lipschultz and Emily Grafeo. They are here with us on the desk. Neither one really speaks Spanish.
I'm doing Duolingo in Japanese, so that's kind of cool.
That's not helpful right now.
Yeah,
though.
it doesn't. Well, it could have helped at the NASDAQ. I don't know what that was, but
let me show you what's happening when we look at the market rally and just how broad it was. All right, let's pull up the IMAP, which typically shows you how the different sectors are performing. It's pretty basic, pretty simple this time around. All gains all around for the 11 industry groups. You have materials leading the way, up 3%. Tech gaining 2.5%, along with energy. The worst performer, so to speak, are consumer discretionary stocks gaining more than 1%.
Can I just say, I really prefer GRR. If you type SPXL1 index GRR on the Bloomberg terminal, I think it's a better way to read that information.
Anyway. It's still all green.
That's a good point. It's a good point.
Not today. Today, this is the right picture.
So I used MRR, member ranked returns, to find
nice segue.
Some of the individual performers, and I found Newmont up there. It was the second best performer in the S&P 500 on the day. It's a gold mining company. It was up about 8%. This is like a picks and shovels story. Gold is hitting a record high, so the next obvious place to go are the miners there. And they also got an upgrade from UBS to buy from neutral. UBS also hiked the price target to $60 from $50, as they also hiked their target for gold. But the big story today was really the big banks.
Earnings season began.
It's earnings season. I was looking specifically at JP Morgan because, Jamie Dimon likes to talk. He did strike a cautious tone about the prospects for the U.S. economy in a statement Friday. Accompanying the results, he said he expects a kerfuffle in the U.S. Treasury market that prompts a Federal Reserve intervention. We'll see if we get one of those. But overall, J.P. Morgan, pretty strong results. Record equities revenue, $3.8 billion. That was a 48% jump. All of that market chaos is boosting J.P. Morgan.
I like what you said about how Jamie Dimon likes to speak, because he did talk this week, and it was pretty effective in getting through to the White House.
Yes, he is the head of the biggest bank, and I think he talks and people listen. And
I'm looking forward. We're going to have Beth Kowitt on from Bloomberg Opinion in a little bit, and she's going to explain. It used to be, in order to get Donald Trump's opinion, or attention, I should say, and change his opinion, you had to write him a check. And now it seems there are
maybe
different
you need
approaches.
to do that and something else.
Yeah, well, I don't think Jamie Dimon's writing him a check, but he knows to go on Fox. He knows to be incredibly flattering. He knows to try and make Trump think it was his idea, to get him to do these things.
And we did get Fed comments this afternoon after Jamie Dimon spoke about potentially the Fed being there to step in if there were any liquidity problems.
Also, BlackRock was higher, right?
Yes, another CEO, Larry Fink, CEO of BlackRock, he also gave us like a macro outlook. He said the U.S. tariff announcements went beyond anything I could have imagined. In my 49 years of finance, this isn't Wall Street versus Main Street. It impacts people's retirement savings. Overall, BlackRock, they had earnings. They were mixed. Assets under management were slightly amiss. The EPS beat. Net inflows missed. I picked BlackRock because I write about ETFs. They're the biggest ETF provider.
A little bit biased, but we get it.
Well, they manage like $12 trillion of assets.
Yeah.
It's just absolutely mind-blowingly massive.
My favorite thing is when CEOs are bearish and their stocks go up. So Emily gets to talk about them in a positive light, but I get to talk about the companies that are doing poorly and trading to the downside. And with that, going to look at some of the semiconductor stocks. Texas Instrument, Emily and I were talking about it on Bloomberg Radio. Yes, they make calculators, but they're also a chip manufacturer, as well as Intel. Under pressure, guys, because of the China tit-for-tat tariffs, Beijing raising tariffs on U.S. goods. They're two of the companies that actually make chips in America. So they're actually getting dinged to the downside. That's on a day when the Philadelphia Semiconductor Index was up 2.5%. So one of the worst days in quite some time for Texas Instrument. Intel kind of held me on the edge of my seat, only closing down 0.7%, but still that stock's down 47% in the last 12 months.
We also don't have any clarity just yet on Intel and what happens with its foundries, because there's a lot of discussion there on whether it's going to team up with someone else or whether someone's going to buy it.
Well, that's fundamental news, right?
Yeah.
And that's what should be moving stocks, but because we're in the era of a trade war, it's kind of where are the animal spirits? Where are we all going? And today, at least, when you look at kind of digging underneath the surface, that's why these are two of the worst performers in the semiconductors index. But again, foundry is an issue that Intel has to kind of address.
I saw you also had Old Dominion on that
Old
board.
Dominion. So what's bad for the economy and bad for shipping and trading is bad for trucking indexes. So we are looking at the Russell 3000 trucking index down 2.2%. One of the worst performers in that basket was Old Dominion, stock down 2.9%. Again, very choppy backdrop for companies that are moving goods. And as long as Chinese goods aren't coming into America, bottom line is when you talk to analysts and investors, that's bad for the companies that move them. So looking at them, one of the worst performers in the S&P 500 alongside Texas Instrument, two of the bottom three. But again, in a day that has quite a bit of green, that's pretty sharp divergence between the bottom and the top performers.
All right, I'm looking at yields, and they may not have a lot of impact on the individual movers, but they've had such a huge impact on the index level, stocks at the index level, that I think you can't afford not to watch Treasury yields. Right now, the 10-year at 447.77. It is lower than it has been throughout the day, but it rose for a fifth straight day, and it's been an incredible week. I think it's still up 50 basis points relative to A, where it finished on Friday, and B, to its German counterpart, the Bunds. And you haven't seen that big of a spread between Treasuries and Bunds in yield terms in a decade over a week. So pretty incredible.
Also, you look at the 30-year, that looks like not a big move, but the swings it's seen over the past week
huge.
are incredible.
I mean, I don't know how high the 30-year went today, but I was looking at one point at 495.
Almost 5%.
So it's definitely gotten 10 basis points or 12 basis points of movement in the session. And the 20-year, by the way, was up at 5 and through as well. I am like one of the only people in the world who watches the 20-year.
I was going to say, no one looks at the 20-year. There aren't enough of them.
I like it because it's unique. You know, I don't want to have the same bonds as everybody else.
Okay, so you're doing it just to be different.
Yeah.
Okay, got it. You know, in terms of what you're looking for to be different next week, I guess now that Susan Collins of the Fed has made clear that the Fed is kind of there to provide stability if needed.
But was that not clear already, by the way?
Right.
I thought that FT story wasn't very surprising.
But the fact that she said it matters, right?
Yeah.
The fact that she said it matters. It shows that there is a Fed put to some extent.
I guess. But like,
when isn't there? That's their job.
No, exactly. I was going to say that's kind of why they exist, but I do think that, again, we saw partly the markets rallying just because people needed short coverage. If you're going into a weekend, there could be some kind of news event, but that's what we saw on Wednesday when Trump waved his magic wand and said tariffs were mostly paused. We saw markets rallying, and it wasn't when you talk to fundamental investors because things were better. It's just that, well, at least you can take some of your bearish bets off the table.
Don't you think the Fed, I mean, obviously, if it gets disorderly, they're going to step in.
That was my
They're the lender of
reaction.
last resort.
And also, if things get disorderly, that would be bad. So, I mean, yes, they'll step in, but what if it's too late?
Yeah.
So, but we did see the market.
It's no reason
go
to be
up.
optimistic. Oh, good.
Yeah.
The Fed's going to
Great.
step in if
something terrible,
everything goes to hell.
More relief than optimistic,
liquidity
right?
breaks.
All right, Bailey Lipschultz and Emily Grafeo, thank you both so much. Have a great weekend for helping us close out the market on this Friday. We've got a lot more to come on the close because coming up, the U.S. dollar, meanwhile, did decline on the day, lower by 1%, also at a 6-month low. We're going to discuss the currencies move next with Stephen Englander. He is Global G10 FX Research Head at Standard Chartered Bank. This is The Close.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Foe.
And I'm Matt Miller. Really happy to join you.
Oh, I'm so glad you joined us because when you opened the market today at 9:30 a.m., did you think we're going to end with these massive gains?
I didn't think so. And also, it no longer looks like massive gains to me.
Fair enough.
A 1.8% move is fairly small. It's more than I expected, to be honest with you, this morning. But the more shocking number is the weekly gain, right? 5.7%, the best week that we've had since November of 2023.
Yeah, pretty remarkable.
Yeah, and I mean, the 10-year yield, I just got finished saying why we're all paying such close attention to rates. Even at 448 doesn't look like a massive number. Remember, we were getting closer to 5% on the 10-year at the end of last year, beginning of this year. the real interesting asset price action, I think, is in crude, $61.57. Okay, it's no longer 55 like it was for a couple of days earlier this week, but it's still very low for, drill baby drill is out at this point. We need to get $20 higher before anybody in Texas gets excited. And then gold, absolutely fascinating, $3,235. Yes, a weaker dollar helps out, but it's just another all-time high, another superlative from market assets this week.
And this is a safe haven that investors around the globe seem to agree on. Finding safety in gold. And let's go to our individual movers, because that benefited the gold miner Newmont Mining. You could see that stock closed up almost 8% on the day. UBS, by the way, upgrading Newmont to a buy, citing the improving macro backdrop for bullion. Also, some chip makers in focus. Texas Instruments and Intel, they declined even as the Philadelphia Semiconductor Index rallied on the day. These are chip makers with U.S. manufacturing plants. They fell after Beijing raised tariffs on all U.S. goods to 125% from 84%. But in particular, it's because these companies make chips in the U.S. And that's the distinction that China is making right now. It's not the country of origin, but where the chips are actually made. So companies that design chips but don't make them in the U.S. Seem to benefit, like NVIDIA and TSMC, which finished higher on the day. All right, let's take a look and consider what we've seen this week and really for the past 2 weeks, and bring in now Bob Dahl. He is President, CEO, and CIO of Crossmark Global Investments. Bob, what did we learn from this week in terms of how quickly policy can change?
It can change really fast, and we still have massive uncertainty. You've talked about it already, but I think the big story this week was the move up in Treasury yields. I remember earlier this week seeing a print of 380 on a 10-year, and earlier today, 457. 77 basis points in less than a week. That's massive. Something's going on. That's obviously bugged Donald Trump a bit, which caused the 90-day delay, which is obviously part of the story this week. But I think there are other signs out there, maybe concern about deficits, maybe concern about inflation. They're the stories of the week, I think.
Absolutely. And technical factors may also have helped accelerate the sell-off in treasuries, a lot of unwinding of the basis trade. I'm curious to hear from you, how much more of this basis trade do you think needs to be unwound?
At 457, I guess 447 going out, I think a lot of it is there, at least in terms of price. We may get a lot more volume at those kind of prices, but I think the equity market would really struggle if we, say 475 on a 10-year. I don't think we'll get there. The next move could be back down some, but that 380 was mind-boggling earlier this week.
I mean, we were at 475 on the 10-year at the end of December, beginning of January, around there. Why do you think 450 and higher seems like the danger zone right now?
Because the economy has gotten so much weaker since December 31st, and we've yet to see confession season, companies coming out with, our first quarter was okay, but man, we either have no visibility on second and third quarter, or we're seeing a lot of weakness. I think that's in front of us. Estimate reductions, which usually obviously means higher bond prices, lower yields.
By the way, we talked to Mike Santomassimo at the top of the show, Bob, and he was talking about looking for kind of stability and clarity on the other side of this. All the bank CEOs were saying similar things this morning. Do we get stability and clarity at the end of this 90-day period, at the end of this year, at any time in the next, 4 years?
Yeah, I wish I could answer that question, Matt, yet, but yes, but Matt, but you've already in your question kind of tipped the hand. Look, I think the uncertainty is going to be around for a while. Perhaps earlier this week, before the 90-day delay, we might have hit peak uncertainty, but 90 days from now, we're not going to have all the answers for sure. And look, a lot of people having gone through this period are saying, I don't know how much I can really bank on any kind of certainty around things. I need to be concerned. It seems like every day there was a new rumor, a new rule, a new way of looking at tariffs. So I don't think we're going to have a whole lot of clarity 90 days from now.
And we also saw that this week's volatility sparked a lot of speculation of blowups in hedge fund trades and of foreign investors leaving U.S. assets en masse, especially treasuries and the dollar. Where do you see the greatest dislocations? I mean, if this volatility picks up again and continues next week, do you see a market event as inevitable, something systemic kind of befalling us?
Certainly possible, given the rapidity of changes in asset values. It's actually surprising to me that we haven't seen an accident or more rumors of an accident. Yeah, we've heard some noise about the private credit and some problems there. These big moves tend to upset things that are on leverage, and we know a lot of that is on leverage.
What do you think about the sell the rally strategy at this point? Are we out of buy the dip, and have we moved into a structural bear market? Could we see something like 2001, 2002, 2003?
I think the technicals are still dominating. That is to say, we had the panic low, if you will. Now we're in the rally phase, which I don't think is yet over. But the whimper after the bang implies a test coming of those lows. I think of 1987, that test came weeks after that primary low. So it could be days or weeks before we see it. And then the question will be fundamentals. How good is the economy? Yeah. If it looks like no recession, we'll make the low and that will be it, and we'll bounce around. Conversely, if we have a lot of estimate reductions because people are concerned that we are going to have a recession, then I'm afraid we have to go lower. Stocks are still not yet cheap, as you know.
Bob, great to get some time with you. Really appreciate it on a Friday afternoon. Bob Dahl there, President, CEO, and CIO of Crossmark Global Investments. And, it's interesting, Scarlett, I think everyone fears a structural bear market, unless you're going short. But in 1987, and we've been talking so much about superlatives, worst 3-day run since COVID or 87, they actually ended the year up 2%.
And people forget that because it was so scary for so long. Kind of in the same way that we ended the week up, even though it doesn't feel like we should have.
Very good parallel. Coming up, the U.S. hitting a 6-month, the U.S. dollar, I should say, hitting a 6-month low. We're going to discuss currencies with Stephen Englander. He is global G10 FX research head at Standard Chartered. This is the Bloomberg Dollar Index you're looking at. This is the close.
With investors on edge as tariff headlines spark volatility across global markets, Bloomberg Surveillance has the insight and commentary to give you a jump start on the trading week. Tune in for special coverage this Sunday starting at 6 p.m. Eastern. Context changes everything.
The U.S. dollar plunging to a 6-month low as the global trade war risks derailing U.S. growth. Joining us now to discuss is Stephen Englander, global head of G10 FX research at Standard Chartered. And what a ride it's been for the dollar, Stephen. To what extent do you think the Trump administration wants to drive this kind of outcome? We heard Scott Bessent say, I think very recently, that the U.S. still has a strong dollar policy. But the president has talked for a long time about how, I guess, unfair that is to have such a strong currency.
Yeah, look, I think the issue is what gives it the strength and what gives it the weakness. I think the kind of weakness we're getting now, where the market is appears to be losing confidence in U.S. assets across the board and losing confidence in policy. Not sure that's the kind of weak dollar that he wants, and it'll give the U.S. much more advantage. And by contrast, I think if we had a strong dollar given by productivity and growth, that wouldn't be the worst thing in the world.
So is the weakness in the dollar really reflective of just slowing growth expectations for the U.S. economy, or is it something worse? Are there fears that the U.S. may not be able to meet its financial obligations at some point in the future?
No to the second one. But that doesn't mean there's not concern. I think the Miran speech a few days ago, where he's to international finance what Navarro is to tariff policy. He kind of wasn't taking any prisoners. I think that told the market that what the U.S. was doing through tariffs, that they might turn around one day and do that through the dollar and through international financial arrangements. So it's not like a speculation that the U.S. is going to default, but it's certainly a fear that international financial relations may change dramatically.
We all take it for granted that the dollar is the world's reserve currency, but you look at WCRS Go on the Bloomberg terminal over the past week, and we showed it earlier, and the Swiss franc is the best performer against the dollar this week, gaining more than 8%, the euro gaining about 4.5% versus the dollar in that time. Is the U.S., are investors slowly positioning to account for perhaps not making the U.S. the reserve currency of the world?
You know, I think they've been trying to do that for a long time. And I don't think it's ready yet to be kind of deleted as a reserve currency. It's possible that some of the move this week was reserve managers diversifying out of the dollar. But I think that it's not a reserve currency just because it's the dollar. It's because of the depth of U.S. markets and historically, it's been a good place to put your money, both for investment returns and protection. That doesn't seem quite the case right now, but we'll have to see how things evolve and whether confidence in the U.S. can be restored.
What kind of disorderly activity, if any, did you see this week? And could we be looking for in the weeks to come if the volatility continues?
I wouldn't call it disorderly. And I'd say that it seemed, looking at the way the dollar was moving, that there were very few bids. Nobody was putting out their hand to say, hey, the dollar's fallen enough. What that meant is that a relatively small directional trade could move the dollar much more than it would under normal circumstances, because under normal circumstances, there'd be a bid for the dollar. This week, it just didn't seem those bids were there.
Stephen, the offshore Chinese yuan, CNH currency on the Bloomberg terminal hit the highest level, I guess its lowest level against the dollar that I can find in my records here. Do the Chinese have to actively do anything to allow this to happen, or do they just widen the band?
I think that they respect markets and kind of, obviously there was some market pressure in the first instance as the escalation of the bilateral tariff war between China and the U.S. proceeded. But I think the fact that it's finishing the week at 727 tells you something, that they're, it seems to be a signal that they're not out there to use the yuan as a weapon.
All right. Steve Englander, always a pleasure speaking with you. Steve Englander, Global Head of G10 FX Research at Standard Chartered. And of course, the dollar, one of the big stories of the week, as the dollar does close out with a 2% drop for the week, off 1% on the day, as we continue to see perhaps some questions over the U.S. dollar and the love of U.S. assets in this moment. Coming up, Wall Street applying pressure on the White House. We're going to discuss the state of business leadership with Lisa Donahue of AlixPartners next. This is The Close on Bloomberg.
From Jamie Dimon to Bill Ackman, top executives applying pressure on the administration, resulting in Trump pausing tariffs on several countries. Beth Kowitt of Bloomberg Opinion writing, quote, a collective high five went around Wall Street. Flattery is not exactly a new strategy for getting what you want, especially when it comes to negotiating with the president, but it gets the job done. Beth Kowitt joins us now. Beth, great piece. Highly recommend terminal users go to OPIN Go and read it, or non-terminal users go to Bloomberg.com. What do you think is the most important aspect of getting President Trump to do what you want? I mean, you point out that writing a check just doesn't cut it anymore.
No, I mean, I think we saw a lot of tech titans try that approach, not really working for them. What I thought was really interesting here is a lot of Wall Street executives try to speak to Trump through platforms and mediums that they know he watches and listens to. So social media, business news, business TV in particular, Fox Business. So I think it was very calculated, that way they can get to him without any intermediaries in some way.
Yeah, I know a trader who was saying to me that he would know when market sentiment turned and when the administration was ready to do something if the anchors on Fox started to change their tone. That would be the giveaway. So he was watching it very carefully just to kind of read between the lines. But even then, speaking on Fox or to a network like Fox, the CEOs who do speak up need to be careful about how they do so. You can't go in with guns blazing, rhetorically speaking. There's a practice when you give feedback in offices and even to school children called a feedback sandwich or a criticism sandwich. And that's kind of what the CEOs have opted to do here.
Definitely. Jamie Dimon, for example, did not go into his TV appearance, all scorched earth or anything like that. It was very calculated, put out there that he understood kind of what Trump was trying to do with tariffs, but that maybe this wasn't the best approach. Ackman took a similar route. I mean, he also really padded his criticism too. So I think that's kind of the new strategy, or maybe not new strategy, but just make sure that everything you're saying is not quite so harsh or targeted.
Well, and there's got to be an element of inception as well, right, Beth? You've got to make the president think that what you're suggesting was his idea to begin with, that this was his strategy all along.
This was, I thought, kind of the most interesting and amusing part of it. So Ackman was the one that initially suggested the 90-day pause. And after the fact, he very much let the administration take the credit. He put on Twitter, or he put on X, I'm sorry, beautifully executed, classic art of the deal, something like that. So, he let Trump and the administration take the credit, and again, flattery.
Do you think any of these masters of the universe is just a little bit embarrassed by how sycophantic they have to be?
I mean, it's possible, but I think they're probably weighing that against what's going on in the economy and deciding that that's a trade-off they're willing to make.
Yeah, they're being pragmatic first when it comes down to it. Beth, really appreciate your joining us. Beth Kowitt of Bloomberg Opinion there on how to get the president's attention. All right, well, business leadership clearly in focus here as we progress further into earnings season. Jamie Dimon suggesting more companies will be withdrawing their guidance because of the turmoil, opting for a wait-and-see approach. Joining us now to discuss is Lisa Donahue, co-head of Americas and Asia at AlixPartners. And withdrawing your guidance is one way of not committing to saying you don't know what's going to happen, because none of these guys know what's going to happen. You and your colleagues over at AlixPartners work with chief executives to figure out how to position themselves through this kind of turmoil. And one of the ways they're doing so, because it is so difficult to pivot at the speed that the president is changing his policy, is to create tariff war rooms. Walk us through why that's a good approach and that's a good framework to operate in.
Sure. Thank you for having me. Listen, your point about CEOs not being able to pivot at the speed of the policy changes is exactly the right one. So yes, we talk about tariff war rooms, but first and foremost, what we also talk about is the fact that the macro drivers for the long term, AI, energy, et cetera, are still the main drivers that you want to be focused on when you're thinking about how you're doing some long-term planning. More short-term planning, though, what a tariff war room is exactly what it sounds like. It's strategizing different scenarios on how to react as these tariffs move. So we've developed a tool that takes into account on a micro level every bit of every component of a manufactured product, the country of origin, the tariff applied, and different scenarios as they move, and different tools that you can use to think about how to mitigate. One thing that you can think about is moving portable things, or things that are a little bit easier to move to a lower tariff location. Obviously, you can't move a manufacturing plant. Sure. You can't move the assembly line, but some sub-assembly, some labeling, some testing, some other elements of the value-added component of the product can help drive down your overall cost.
But how do you go about communicating this? I mean, as you're trying to game out different scenarios and your different options, there's a lot of question marks. And I mean, it's one thing to talk about it on an earnings call and codify it into a formal guidance. But how do you communicate this with your own employees, with your customers, with other stakeholders?
Well, having sat in the CEO chair and had to communicate some pretty tough messages, what I find is the best policy is to be open, transparent, and bring your employees along so they understand that there is a way out, that it's turbulent, it's complicated, but for a short term, and we do believe the long term, as I said, the macro factors are still in place. I do believe ultimately that tariffs will be a new way of life. It's just a question of where they settle in. And from there, you can start your medium-term planning and then ultimately your longer-term planning. You know,
I keep thinking of the hurricanes that hit Florida and the Carolinas, the wildfires in Los Angeles. They're reminders that environmental factors still really matter to a lot of businesses. I feel like you also want to have, you know, a diverse group of people. If you're selling a product that you want a lot more people to buy, right? But we don't really talk about DEI or ESG in a positive light. If you're a CEO, do you still have to think about those things longer term?
If you're a CEO, you definitely have to think about those things longer term. And I think from a DEI perspective, what I've always believed, and I think what most people have always believed, what DEI is about equal opportunity and getting the right people sitting in the seats and people being judged on skills and ability versus what they look like. And I do believe that it's still a critical component, because having been in the room with tough negotiations, I'm here to tell you that having diversity of thought and lots of perspectives and opinions to coalesce around a tangible solution is the best solution. And from an ESG perspective, as you correctly point out, these natural disasters are a fact. So figuring out how to mitigate, how to deal with them in a responsible manner, whatever you want to call it, they are still there. So figuring out how to deal with them is very important.
All right, Lisa, great having you on the program. Thanks so much for joining us. Lisa Donahue there is co-head of Americas and Asia at AlixPartners.
And of course, as these CEOs try to make sense of the world that they are in right now and kind of offer reassurances on what's happening, let's show you what happened in equity markets today. Not just equities, but across asset classes. The S&P 500 closing up 1.8%. Actually rounding off its best week since November of 2023. So thanks to that banner gain on Wednesday, this was an up week here. The 10-year yield inching up by 5 basis points. And I say inching up. Normally that would be a pretty big move, but these days it's the equivalent of inching up, isn't it?
Yeah, absolutely. And if you want to look at, US GG 10 index HCP space W. Look at it on a weekly basis, right? Yeah. It's 50 basis points that we've seen the 10-year yield rise. So it's not inching. It's a massive leap. NYMEX crude as well has had a really volatile week. It's been down as low as 55, now at 61.51. A lot of people are going to be feeling relief at these levels, but certainly they won't be drilling any new wells. You may want to pull some more gold out of the ground, though, because $3,237 an ounce. It's going to close at an all-time high.
Easier said than done, Matt.
Yeah, I'm sure. But you know what? The dollar, if you're dealing in euros, right, you can buy more dollars with which to do it. So.
All right, this is the close on Bloomberg.
U.S. consumer sentiment tumbling to an almost 3-year low as price expectations rise on growing tariff concerns. For another read on the state of the consumer, we're joined by Rebecca Hessel Cohen, founder and creative director of clothing brand LoveShackFancy. And I'm guessing you have a different client, really, than those who typically respond to the University of Michigan Consumer Sentiment Survey. But what is your client feeling like right now?
Our client is our client is always pretty much happy and optimistic, to be honest. I mean, LoveShackFancy is, a community of women and girls that love to dress up. They love clothing. They love our collaborations, which are constantly happening. Obviously, we know what's going on in the world and in the market, and good thing today is a good day. But, I think everyone is a little bit at unease in terms of the volatility that's going on, especially with the tariffs, but working through it and just taking it day by day. And, at LoveShackFancy, we're working so closely with our partners, our factories, and just like having an open dialogue with our customers.
How hard are these tariffs? I mean, I know on the one hand, it's very expensive to have things woven, cut, and sewn in the U.S. But on the other hand, you don't necessarily want everything out of the U.S., right? There's more fashionable, maybe mines in Europe. They're maybe better at producing fabrics in Japan. So you want to be taking things from all over the world.
Right, yeah. So, I mean, we're so lucky that we have amazing factory allocations all over. Our partners, like our strongest partners, are in India, which is great, and they are such artisans and craftsmanship. You know, their craftsmanship is really incredible. So all of our embroideries, our beautiful beadwork, everything really, that so much attention to detail is done there. And then, so we're working closely with them to figure out tariffs, costs, everything like that. And then in terms of China, we are pivoting and moving things out of China, you know, into either it's going to be Vietnam, Cambodia, more over to India. They're so excited to get more of our business, and they're going to be working closely with us. You know, we're sending tech designers over there. We're going to be just teaching them how to cut on the bias more closely, and we really just value, you know, the expertise and the quality of our pieces and the quality. Yeah, so.
So I wonder, Rebecca, could you do any of that at home? Have you considered?
In New York?
Yeah, in New York, somewhere in the
US?
States?
Well, when I first started and I only made like a few hundred units, we did everything in New York and LA, and I produced everything. Now, you know, our units are really high. We make, I mean, across all categories, include, you know, we make about like 1 million units. So it's impossible to do that here. We do some cut and sew in the US, sweatshirts, t-shirts, things like that. But when it comes to intricate embroideries, beadwork, all of that, it's really artisanal. So the craftsmanship, everything is like very focused. You know,
So by the way, it's impossible because A,
we just don't. We don't
the wages
have
are too high, and B, we just don't have that.
We don't have. Yeah,
talent.
we don't have the talent here. So, and you know, in India and in other places like Peru for their knitwear, like that's so incredible. Like this is such specialties that these countries and these artisans pride themselves on, and there are extended families and our extended companies in India. So
of course, you want to make sure the quality of your clothing is maintained.
Exactly.
And you uphold all of that. So, having said all that, even so, with the rollback of the reciprocal tariffs, there's still a 10% tariff in place.
Yeah.
What are you thinking of in terms of your pricing? Do you need to raise prices? Can you absorb that increase?
So we're basically looking at all the different price structures and options, and we have like the price structure of good, better, best for all our different pieces and all the different categories. I mean, our clientele, our customers are babies to 80s, so we really span all ages. And so we're looking, you know, when it's simple cotton pieces, that's one thing. When it's more intricate beadwork and the prices can be raised a little bit, we're going to make sure. But it really depends on price value and what our customer wants. I'm so much that customer too. My friends are, our daughters, you know, so we really know, and it's really the perceived value. The most important thing is to really deliver the best product possible to our customers and to be able to also, you know, make the margins and things like that.
Rebecca Hessel Cohen, thank you so much for joining us
today.
Thank you. She is founder and creative director of LoveShackFancy. Now we're going to stick with retail and bring in another angle. Nancy Rhodes is co-founder and CEO of AlterNew. It's a platform for clothing alterations and repairs. So the idea being that if you have a LoveShackFancy dress and something happens to it, you want to be able to repair it rather than go out and buy a new one because, or another dress, because you want to make sure that you can sustain the clothing that you do have. This is something that brands are on board with, isn't it?
Yeah. So longevity is a strategic advantage, right? And so we are piloting with Faherty. We are going to be launching with Everlane in 2 cities. And we're also working with resale logistics providers and manufacturers. So care and repair are such an integral part of the consumer journey. So being able to provide an operating system to support that, look at OpenTable, ZocDoc, Airbnb, they all took fragmented, antiquated industries, modernize them through technology. We're just doing that for a new category. And if you look at it, there are 4.5 million registered tailors and makers. And let's talk tariffs, right? Like there's all these rising prices. The infrastructure is here. And maybe not at the level at which, you know, Rebecca needs it, but at the level to support a consumer journey that goes beyond the register.
How hard is it to find the right talent? I mean, because I ride motorcycles, I'm often trying to alter leather jackets or suits, right? And I have a pretty big wingspan. It can't work with off-the-rack stuff. But it's difficult for me to find someone who can really work with heavier cloths.
Yeah, so first of all, that's awesome. super cool. One of the things I say is clothes are mass-produced, bodies are not. And so we're always getting that question. In fact, we are B2B SaaS, so we support brands. But we did a consumer demand survey. Dating is hard, finding a tailor shouldn't be. And we got all of these responses and needs because everyone is like you. They need that. But the way we're doing this is through our tech. So today we're launching in New York. We have access to over 160 tailors in our pipeline, and we're supporting them. But the problem is that the tailor who can hem your jeans might not be the tailor who can take in a Gucci blazer or your motorcycle leather jacket. And so being able to triage and understand who does what at what price allows us to create a more streamlined way to find talent and support them.
I've been looking for a business
Great,
like
I got
yours.
a guy for you.
What about the price, though? I mean, I go, if I want a great tailor in Hartsdale, there's Mr. Pitti. You know, this guy came over from Italy. He's incredibly talented, but he alters one suit, and it's like charging me for two. So how can you keep price down?
Well, part of that is saturation of market. They can charge whatever they want because you literally just said, I can't find a guy. So you got your one guy, you keep going to him, and there's actually other people who are totally equipped to do this and are doing it at half the price, but you can't find them. So you're finding people through word of mouth, through opportunity, and using tech to support modernizing those industries will allow us to reduce the price because you're going to have more choice.
Nancy, what are you seeing in terms of demand, or what do you anticipate in terms of demand now that the tariffs are here? And I know that there's some of them are on, some of them are off, but the de minimis loophole has been closed where China can export goods for less than $800 and be exempt from tariffs.
Yeah, so there's, first of all, understood that these brands are dealing with chaos right now. Prices are changing every day. They're trying to understand their sourcing strategies. But where we see a unique opportunity, and you look at that at resale, you look at that at repair, you look at that in digital product passports, it's all about creating a broader brand experience for the consumer. And so for us, this has there's a reason why there was the high five between James Reinhart, the CEO of ThredUp. We're leading with compassion, absolutely, but we've always been stuck in sustainability, right? Like, okay, this is a sustainability play, but now it's table stakes. Now understanding your consumer beyond the register. If you look at these brands, they're spending billions to get their customer to the register, the product, the marketing, and then they're losing them after the sale. So how can you provide a post-purchase experience that brings your customer coming back?
Got it. How to keep them within your empire and make sure that they see some loyalty because you value the products as much as they do.
Yeah, even where we launched a pilot with Faraday, they're doing repair with us, but they have resale on their platform too. So you're able to get all of this different tech to support resale, to support repair, to support rental, all within the brand journey, and that's creating a great experience for the customer.
Nancy Rhodes, co-founder and CEO of AlterNew. Thank you for joining us.
So great to be here.
All right, still ahead, we've got what investors need to watch for over the next week. A lot of earnings coming up and a lot of data coming up. This is The Close on Bloomberg.
It's a big day for our organization. Anytime you have the opportunity to pick first over on a draft, it's a big day. Once in a while, though, you hit it right where you get the first pick in an extra special year. That's this year. We have an opportunity to make a transformative selection.
And that was the Dallas Wings CEO sitting down with Bloomberg's Julie Fine, pushing ahead to Monday's WNBA draft.
And that's only the tip of the iceberg in terms of what we can expect over the next week, because also on Monday, closer to the markets, EU foreign ministers are meeting with tariff strategy front and center. So they're going to be discussing how they respond. They have 90 days, I guess, for now to figure this out. There's a lot of negotiation in between.
Yeah, plus we get earnings from Goldman Sachs. Obviously, bank earnings kicked off today, but they pick up again on Monday with Goldman. And then on Tuesday as well, we have more bank earnings at Bank America and Citi. And plus, it's April 15th.
Did you file your taxes yet?
I finally did it on time for like the first time in my entire life.
You didn't ask for an extension?
No.
Impressive.
This is the first. I'm 51, and this is the first time I didn't ask for an extension.
Applause. Okay. Well, on Wednesday, the world waits for Jay Powell to speak. That'll be midday, and of course, we will bring you that those comments when it happens. And U.S. retail sales also coming out. That'll be really interesting in terms of clearly it won't fold in the latest drama from April, but it will show some of the weakness or concerns that consumers have been feeling.
Yeah, absolutely. On Thursday, we have the ECB rate decision, which I think is important in two ways. Number one, everyone's watching so closely to see how many cuts the ECB can deliver, and the euro dollar has been fascinating to watch. Number two, we will show the press conference in its entirety in my program.
Oh, there you go.
On Bloomberg Open Interest every day from 9 to 11.
Such a shameless plug. We also have the Italian Prime Minister meeting with President Trump as well. So
and hopefully she can get some
headlines out of
tariff carve-outs for Ducati.
And of course, on Friday, markets are closed for Good Friday. In the meantime, have a great weekend, everyone.